Hey everyone, so Japan's stock market has been on an absolute tear, right? It's one of the world's top performers this year, no question. But if you dig just a little deeper past those huge soaring numbers, well, you find a much more complicated story. It's this incredible story of powerful forces pushing and pulling against each other in a really delicate, high-stakes balancing act.
And that right there, that's the central puzzle we're going to unpack. You've got the headlines just screaming success, but then you listen to the whispers among investors, and it's all about risk and uncertainty. So, how can both of those things be true at the exact same time? All right, let's get into it.
So it all really boils down to this one big question. If Japan's market is a global frontrunner, why is there so much talk of risk and uncertainty? I mean, if everything's so great, why does it feel so tense? To figure this out, we have to look at both sides of the coin, not just what's pushing the market up, but also what's trying to pull it back down.
Okay, first things first, let's be super clear. This boom is the real deal. I mean, just take a look at this chart. You can see the year-to-date performance of the world's major stock markets. And yep, there's Japan's Nikkei 225 sitting right at the top. It's blowing past Germany's DAX and the US S&P 500. This isn't just a tiny lead, folks. Japan has been the undisputed frontrunner.
Plus 29%. Just let that sink in for a moment. A 29% return, year to date. That one number tells you everything you need to know about the sheer scale of this bull run. That's the kind of performance that makes the entire world sit up and pay attention. But as you know, numbers never tell the whole story.
So how do we solve this puzzle? Well, we're going to use a pretty cool framework to do it. It's a 4-layer analysis that's going to help us break down all of these competing forces into really clear, easy-to-understand pieces. See, this framework, it goes way beyond just simple economics. We're going to analyze 4 key forces that are always interacting with each other. You've got the market's own momentum, then there's government and central bank policy, the global trade environment, and of course geopolitics. Once you see how these 4 layers are all connected and pushing and pulling on each other, the whole picture really starts to make sense.
And here they are, the results of that analysis. We've got it all scored on a simple 0 to 100 scale. Just think of 50 as perfectly neutral. Anything above that is a positive force, a tailwind, pushing things forward. Anything below 50 is a negative force, a headwind, holding things back. And right away, what's so striking is the contrast, isn't it? The market itself is a strong tailwind, but then you have policy and geopolitics acting as major headwinds, pushing right back. So let's break down exactly what's going on in each layer.
Okay, this is where it gets really interesting. This is the drama of the whole situation. You've basically got this powerful engine trying to rocket the market higher, but at the same time, you've got these 2 heavy anchors trying to drag it straight down. So let's start with the engine.
All right, the market layer. It scores a really strong 68. What that tells us is that the market's own health, its own momentum, is the single biggest positive force at play right now. And this isn't just hype, you know? It's all backed by some seriously solid fundamentals.
So what are those drivers? Well, for starters, you've got really strong corporate earnings growth. That's partly because a weaker yen is making Japanese exports super profitable. Then you have these major corporate governance reforms that are making companies way more attractive to investors. And, this is a big one, we're finally seeing sustained wage growth, which is exactly what you need to fuel the domestic economy. This is the real engine of the bull market.
But now we have to talk about the first major headwind, the policy layer. It's scoring a pretty low 38. You see, after years and years of ultra-loose monetary policy, the winds are definitely changing. The government and the Bank of Japan, they're starting to pump the brakes.
And here's where you see that internal conflict I was talking about. On one hand, you've got government bond yields hitting an 18-year high. The market is totally bracing for the Bank of Japan to raise interest rates, and that's a classic headwind for stocks. But on the other hand, there is still just a ton of cash sloshing around the system. All that liquidity, basically all that money ready to be invested, is keeping trading volumes really high.
All right, let's move on to our third layer, trade. It scores a 53, so it's a slight tailwind. It's not a huge push, but it's giving a small, helpful nudge in the right direction. I mean, global supply chains have thankfully gotten back to normal after all the pandemic chaos, and even though global demand isn't exactly roaring, that weaker yen is really helping Japanese exporters stay competitive. So yeah, not a game changer, but definitely a net positive.
And now we get to the second major negative force, geopolitics. It scores just 41. You can think of this as this kind of invisible ceiling that's putting a cap on investor optimism. It's that constant reminder that, hey, these big global risks, they're still very much on the table.
And once again, you see this push and pull dynamic. The biggest headwind here is the escalating military tension between Japan and China. That kind of stuff makes investors really nervous, and when they're nervous, they demand a higher potential return to make the risk worthwhile. That's your risk premium. But there's an upside too, at least partially. Global oil prices have been falling. And for a country like Japan that imports a ton of energy, cheaper oil is a huge economic benefit.
Okay, so let's put all the pieces together. We've got 4 distinct forces: a super powerful market, a restrictive policy, a kinda helpful trade environment, and some pretty risky geopolitics. So, what happens when you mix all of that together?
You know, there's a quote from the source material that just captures the mood here perfectly. It describes a bull market where investors want to aim higher but can't ignore the risk of sudden volatility. And that's exactly it. The market is just filled with this tension. Investors look at the fundamentals and they get optimistic. They want to go higher, but they just can't shake that nagging feeling that one bad headline, whether it's from the Bank of Japan or a geopolitical flare-up, could change everything in a flash.
So when you average out all those scores, where do you land? You land right here, at 50. Perfectly, completely neutral. And that's the whole story in a nutshell. That powerful tailwind from the market is being almost perfectly canceled out by the headwinds from policy and geopolitics.
And this slide really shows you that dynamic in action. You've got this massive push upwards from strong corporate earnings and all those reforms, but you have an equally strong pull downwards from rising interest rates and those regional tensions. It's like a glass ceiling. So what's the result? You get a market that's basically stuck in this super tense, balanced state.
So with everything in this delicate balance, the big question is, what happens next? Which one of these forces is going to win out in the end? Let's talk about the key things you're going to want to watch as this story unfolds.
Okay, in the short term, like the next 1 to 3 months, all eyes are on the Bank of Japan. Their next interest rate decision is going to be the single biggest trigger for the market. Then, looking out a bit further, say 6 to 12 months, the real test will be whether Japan can maintain what's called good inflation, where wage growth actually keeps up with prices, and if all that momentum behind corporate reform can keep going.
And finally, let's talk about the 2 biggest risks, the things that could really shatter this tense balance. First, there's the domestic risk. The Bank of Japan moves too fast and raises rates too aggressively. That could easily cause something like a 20% market correction. Then you have the external risk. What if tensions with China actually boil over? That could trigger a classic risk-off event where all the nervous foreign investors just pull their money out.
And that brings us right back to where we started. We have a market that's perfectly balanced on a knife's edge. On one side, you have incredible fundamental strength pushing it up. On the other, you have these huge policy and geopolitical risks pulling it down. So the question for everyone watching this market is simple, really. With the market perfectly balanced between push and pull, which force will win out?